Hello, welcome to the European Open briefing for Wednesday, February the 7th. I'm Rafi Barajan, currency analyst at XM.com, and we're going to be having a look at the latest developments in the currency markets today. The US dollar is broadly firmer this morning, although it has fallen off its earlier highs as the market recovery is looking rather fragile. We are seeing a bit of a rebound in equities. Yesterday, Wall Street posted decent gains, but in Asia this morning, most major indices there have either ended the day lower or are sharply off their earlier highs. In other currencies, the euro and the pound are steadier this morning, managing to move away from yesterday's lows, but risk-sensitive currencies such as the Australian and New Zealand dollars, they've come under slight pressure this morning on the back of that fading risk appetite. So let's start with the dollar. We can see the dollar index in purple in the chart here posted a decent recovery yesterday, climbing to a 1.5 week high of 90.03, just above the key 90 level. It has since retreated to around 89.68. The dollar yen, though, didn't rise as much. It had fallen to a 1 week low of 108.43. It briefly climbed as high as 109.71, but now it's fallen back below the key 109 level, trading just below it. Dollar yen moves replicate that of 10-year treasury yields. We saw large swings in treasury yields between 2.64% and 2.80%. They're currently trading around 2.76%. So it's a bit of an odd story with bond yields, because on the one hand, there is a selling pressure still there because of the expectations that central banks around the world will tighten policy at a much faster pace than initially anticipated. On the other hand, the current risk-off sentiment is boosting demand for government bonds, which are considered as safe havens, and that volatility we're seeing at the moment has actually lowered the expectations of the number of Fed rate hikes in 2018. So following the strong jobs report out of the US, we did see the expectations rise to 3 to 4 rate hikes in 2018, but after the volatility in the past few days, that's fallen back to around 2 to 3 rate hikes. Another potential risk for the dollar is the vote on the funding bill. So the current bill is due to expire on February the 8th. Yesterday, the House of Representatives did manage to pass another short-term funding bill, extending it to March 23. But this now has to be approved by the Senate. So the markets aren't too concerned about that, but that is a potential risk that could arise if senators fail to reach an agreement on that. Let's move on to a quick look at equities. We can see in orange here the S&P 500, those sharp falls of the past 2 days. Yesterday they did close higher, ending the day up 1.7%. The Dow and Nasdaq managed stronger gains of above 2%. The Nikkei in green here, we can see is closed sharply below its highs. It did manage to climb above the 22,200 level before ending there at 21,645. That's just up 0.2% on the day. So we can see that turnaround in risk sentiment during the Asian trading hours. And also worth mentioning the VIX Volatility Index, which is a closely watched indicator of market volatility. It measures the future 30-day volatility on the S&P 500. It jumped to the highest since August 2015. That's when we had that stock market crash in China, which triggered global volatility in stock markets and currencies as well. The yen is still benefiting from safe haven demand. Gold, not as much though. Gold, you could say, is being pressured by the rising government bond yields. In fact, gold yesterday fell to a 4-week low of $1,320 an ounce as the dollar rebounded. It has recovered slightly to around $1,330 an ounce. Let's move on to European currencies now. We can see the euro and the pound. Yesterday, those dips on the back of that stock market volatility. We saw the euro hitting a 2-week low 1.2313. The pound fell to 3-week low 1.3834. Both have now rebounded. The euro is slightly firm around 1.2380. Sterling currently trading around 1.3950. The euro is much better supported than the pound because of those expectations that the European Central Bank will likely end its QE program by the end of 2018, as well as the recent strong PMI numbers we saw out of the Eurozone. Plus, this morning we are hearing reports that Angela Merkel and her party have managed to strike a coalition deal with the SPD party. So that takes one layer of uncertainty out of the market, though there were little concerns about that to begin with. But nevertheless, it does mean that Merkel will stay in power for a while longer. Moving to the UK, though, we do have fresh speculation about the fate of UK Prime Minister Theresa May, as well as some renewed tensions with the EU over the Brexit talks, particularly over the transition deal and the terms of that deal. Plus, recent UK data has been on the soft side. We saw weak services, manufacturing and construction PMIs out of the UK over the past week, and this has widened the UK's performance with other major economies, particularly in comparison to the US and the Eurozone. The UK is underperforming. The next focus for sterling is tomorrow's Bank of England policy meeting. Investors are keen to see whether or not the Bank of England will signal a potential rate hike as early as the May meeting. And finally, moving on to commodity-linked currencies, we can see the Aussie and the Kiwi are down this morning. The Loonie is also slightly lower. Yesterday, the Australian dollar fell to near 4-week low of 0.7832 before recovering slightly, but now it's given up some of those gains as risk appetite has started to fade again. The New Zealand dollar actually posted a very strong recovery yesterday. It had fallen to a 2.5-week low of 0.7255 against the greenback. It briefly rose as high as 0.7351. So that was mainly on weakness with Aussie Kiwi cross helping the Kiwi dollar cross, but now the Kiwi is slightly down around 0.7310. It did get a bit of a lift earlier in very early Asian trading hours from better than expected jobs numbers out of New Zealand. We saw the unemployment rate falling from 4.6 to 4.5% in the fourth quarter, better than expectations, and quarter-on-quarter jobs growth was also much faster than expected, and wages, on the other hand, though, were slightly weaker than expected. But overall, the Kiwi is faring much better than the Aussie. The Canadian dollar yesterday did come under pressure from weak data out of Canada. We saw worse than expected trade figures for December, and the DIV PMI for January also came in below expectation. We saw the Loonie hitting a 4-week low of 1.2565 below, firming slightly. But the USD CAD is just slightly up from yesterday's close this morning. Looking at today's economic calendar, it's going to be a fairly quiet day with just building permits out of Canada and no real major data out of the US. So then the focus will shift to the Reserve Bank of New Zealand policy meeting. The decision is due at 20 hours GMT. We are going to have a number of Fed speakers, though, which will include New York Fed President William Dudley, Chicago Fed President Charles Evans, and San Francisco Fed President John Williams. That's it from me. Thank you very much for watching and have a great day.